Hello, everybody. I'm going to take you right back to basics, which is why bother to use charts? Well, a picture's worth 1,000 words. I know it's corny, but it's true. Some people are more visual, some people are more verbal. What I would suggest is you always play to your strengths. Infographics are absolutely everywhere. There are armies of people working in media, in analysis, in all sorts of forms to help explain the huge data sets that we're currently working with to a layman, and so that it makes sense. People love them, absolutely love them. And thirdly, it's just a basic aide-memoire. Where were we 6 months ago? Where were we 10 years ago? That's really handy. We all work with these all the time. And this is the very, very fundamental bedrock of technical analysis. So moving on to my second quick slide, which I hope to race through. What technical analysts then do is with these ideas, they add mathematical overlays onto the charts. Key is price and volume, but then you have myriad amount of oscillators. You can, take your pick whichever one you want. But the main one, really, the easiest one is a moving average, which measures a trend. Today, stockbrokers call it momentum investing. It's not really momentum, it's just clinging on to a trend for dear life and hoping that it'll continue. Technical analysts actually have a separate measure of momentum, which you can think of as acceleration or deceleration or acceleration to the downside. We then use mean regression, which when I was young, we used to call it the line of best fit. So you can see it's a concept really closely associated with Axel's ideas of fitting a trend line or a trend channel to a price series. Around the mean regression, we use standard deviation. 1, 2 are the standard mathematical ones. I actually like to use 1.6%, which is a Fibonacci number. And if any of you haven't heard of Mr. Fibonacci, I suggest you go and Google him, because he is the most fantastic Italian mathematician that I think ever was. And finally, with all of these things that we're trying to do, oscillators and lines and whatnot, we're trying to spot clusters of price action, outliers to the action, and absolute complete extremes when everything's gone doolally. So my next chart it's not a chart actually. My next slide is why learn a new language? Technical analysis is a language, just like music is, just like algebra, and just like a foreign language. Can I be bothered? That's up to you. It does take work, it does take perseverance, but I'd say that with technical analysis, it may well help your progress in the finance business, and it will certainly help tremendously in your own personal investment portfolio, which I think is a far more exciting and worthwhile part of your time. It also, learning language helps you think outside the box. Language limits the way you think. I'm sure most of you will sort of choke at this, but it does. Literally, language limits your thinking. So by learning something new, you learn to think in parallel and learn to sort of be more flexible. And of course, like anything that you want to learn, you need practice and patience. So now moving on to my first proper chart. Here we've got a proper chart. This is a candlestick chart developed in 18th century Japan, drawn with pencil on paper. Axels explained the candles themselves, which are divided into bodies and the sort of dangly bits, as I call them. I've added a 200-day simple moving average there at the top, and you've got a 50-day moving average. When these cross over, it gives you a buy or a sell signal. Absolutely bog standard. You can, of course, try and optimize this it's a very dubious time. And at the bottom, I've got our actual momentum measure. And you can see that while prices are going up, momentum is drifting. It's not negative yet, but it's really not very happy at all. And Axel's gone through this already, so we'll jump on to my next chart, where I'm going to show you the yield on a German 2-month government bond called Schatz. This goes back to 2013, so it's a monthly candlestick. I've done a mean regression with 2 standard deviations around it since the beginning of the pandemic. You can see that dramatic low where yields here yielded -1%. Price action over the last 2 months has been nothing but catastrophic, I would suggest. We've gone to the maximum Fibonacci retracement in this whole chart. This is not a way to run a country, and it's not a way to run the Eurozone. This is really seriously bad news. Moving on to my next chart, I've got something different, a different way of looking at things. It is percentage moves on European indices. They all start at 100 in January this year, and then they move up or down just in pure numerical values. And so at the very top of the index is Istanbul, which is up nearly 17% this year. Then you factor in depreciation of the currency. The worst performer, and I've never seen anything like this in my very long career, is Moscow, where already mid-February absolutely collapsed, absolutely diabolical. Then they had to shut the exchange. So you see that line almost sideways. Now it's opened again. I don't know who's fiddling around in this market, but it's really not realistic. But it's an excellent way to compare similar and related instruments. The next chart I've got, again, is looking at something in a different way. I want you to think outside the box. This is crude oil, which is currently trading at over 700. That's yuan per barrel. I bet you thought I was going to say $100 per barrel. No, this is yuan per barrel. And this is how the Chinese see it. You've got a trend channel taken from the lows. You can see a massive spike high 3 weeks ago. And more importantly, the up candles are red, the down candles are green. This is how they do it in China, because in China, red is an auspicious color, and red equals good, good equals bullish. You can pick any other color you want on the way down, but I just wanted you to show you that Western values are not global. The other thing here, note the grid lines on the chart. People who are brought up in cities are far better at seeing verticals, horizontals, and 90-degree angles. People brought up in the countryside could probably tell you exactly what the angle of my trend channel is. I can't. I know it's not 45 degrees, but think outside the box and try not to constrict yourself and keep yourself flexible. At the bottom here, I've got something else called historical volatility. It's possibly not as high as you might have thought it would be. And that's because it's not based on intraday data. It's close to close data. So here it's subdued because it doesn't include that spike high. My next chart, I promise you I don't have very many more to go through. It's a quarterly chart. It's excellent. Believe it or not, the best day to look at quarterly charts, the most cynical one, is April Fool's Day, because you've got the first quarter of the calendar year. This is a quarterly chart. Again, if I told you it was 7,573 today, that is yen per gram, and it is by far the highest price this thing has ever been to, ever, ever, ever. You can see there's three quite distinct sections to this chart. On the left-hand side, from 2006, it was a steady, unspectacular rally. Then you had a huge sideways move, which sort of started off as a triangle and then morphed into a rectangle. And then we got quite a sprightly little rally in 2019. I've added Fibonacci retracement. So if it was to go down, at what sort of levels would the downtrend stall? We're nowhere near those at the moment. We're just on the way up. And I've done them red and blue in that consider using your corporate colors in all your merchandise. Red, white, and blue are very, very good colors in financial corporates and countries and all sorts. So that's why I've chosen these. And then my next and final chart is a bit of a trickier one. This is the spread, the difference between the yield on a 30-year US Treasury bond and a 2-year Treasury note. And it's currently just moved into negative territory. Again, we're dealing with negative numbers. I find them very difficult to think of. This is a very long-term chart going back to the 1970s. And you can see that this really swings around a lot. I've drawn some rather random lines in here based on the lower one and then parallels to that above that. And what I'm trying to do here is neither a mean regression nor an Andrews pitchfork, but it's just trying to say what sort of normal and where are we at excessive levels. And I think you'll agree with me that on the downside at the moment, we're not often here, but it's not at an excessive level. It's a bit scary, but it's not doolally land as it was in 1980. Nor is it overbought as it has been in those peaks that we saw at above 350 basis points. That's clearly unsustainable. And with that, I'm going to pass you on to our next speaker, Stephen Roach, who has a very interesting take on the markets. Over to you, Stephen.